An ETF.
A lot to digest, but let's get to the biggest stories right now. The more than $17 trillion global ETF.
Yeah, we start with the basics around, what is an ETF, and maybe do you put it side by side with other, investment structures or compare it to stock picking as an example. Can you unpack that, Billy, before we get into more detail?
An ETF is I use the word modern, probably been around 25 years now, but a more modern version of a managed fund. And it's very similar in that it is a basket of shares that's managed. There's a couple of key differences.
Welcome back to the Winners Playbook. Josh here with Billy, and today we're going to be talking about keeping investing simple with ETFs. So we're going to be talking about what they are, how to build a solid base, and how to avoid chasing whatever is trending online. And before we do get into our topic, Billy, what's the latest on your side, mate? I know you've moved homes and you've had a bit going on in the last week or so.
Yeah, plenty going on. Moved home yesterday to the leafy suburb of Kew. So that's a nice change. Kids changing school, all that stuff. But I got called in at the last minute. I think it was a gig you had teed up at Swinburne Secondary to be a shark in the Shark Tank.
Yes.
So this was a year 11 class, and they set up a Shark Tank style setup for their business class, and groups of students were presenting and pitching their business ideas. And so myself and a couple others were the sharks. So we had to ask some questions and let them know if we are going to buy in or not. So that was cool. That was good fun.
Did you buy in? Who was the winner? Was there a winner announced yet, or?
Yeah. So, we judged it on the spot. So there was a winner. But it was funny because I can't remember the last time I had to speak to teenagers, right? It's not something I normally have to do. So I was like, I better be kind. Like, I don't want to, because on the show they're pretty brutal, right? Like Mark Cuban and all that. So I was like, I don't want to tear these kids apart. So I was probably too kind. I think I bought everything. One of the other guys who I hadn't met before, was one of the other sharks. He was brutal. He was like ripping them apart. I think one of the girls almost started crying. And
No kidding. No kidding. What were the ideas? Any cool ideas that stood out as a cool idea?
yeah, well, they had like a hangover kit, so that was right up my alley.
Oh yeah.
It was called Anxiety.
Anxiety, that's a good one.
Yeah, and the good part of the pitch there, they were like, if you're like, say you're going to a music festival, you could be the campsite hero and come sweeping in with the anxiety kits for everyone.
Hey, that's sounds like could be worthy of dabbling in a few dollars, some seed capital into that one.
Yeah, exactly. Yeah, no, they're actually really good quality. The only thing they fell short
Yeah.
was they had to do like business plans and expected revenue and costs, and the numbers were wild. So we actually suggested maybe they could get us in there before they present, just to fact check some of the numbers. Because like one of them was spending I think $1,000 on app development and cybersecurity.
Yeah,
I
no,
thought
no
that
kidding.
won't go too far, but
Yeah, yeah, no, probably not. Surely there's got to be a bit of AI in there. I'm sure of it, in amongst all of that, but maybe it hasn't been fact checked. So
that's it. Yeah.
no, cool. That sounds good. Well, yeah, I missed out on that one because I was over in Singapore. So I was over in Singapore for a couple of days, less than 48 hours, I think. And then I shot off from Singapore to Philippines, and I was there for about 2.5 days. And then I just got back this morning, back to Melbourne, which was good. But yeah, Singapore trip was really good. Met with some fellow EO members, met with some advisors, met with a really good accountant actually, who's going to be coming up on the podcast in the next month. that has a foreign pension fund set up for high net worth individuals. So I won't say any more, but for any listeners, it's going to be a very interesting one. For the way it was explained to me, a lot of high net worth individuals use it, business owners will use it, and you can still use it if you're an Australian tax resident, even though it's been structured and set up offshore in Singapore. So that's going to be really interesting. But it was good to get out and see the team in the Philippines and spent a lot of time there. We're about 80 staff over there now, so it's also changing really rapidly, and trying to remember everyone's name is the hardest thing to do ever. So I did about nearly 60 one-on-ones with staff in that period of time as well. So it was pretty intense, but it was a lot of good fun, and they always look after me as well, like feed me like a king, and I certainly can't complain. So back home and here on the podcast, I am. But we're going to be talking about ETFs today, Billy. So obviously a lot of work that we do as advisors is around investments and portfolio construction. It's not all of what we do, but it's obviously a part that a lot of clients would generally seek us out for. I'd say probably number one thing they would seek us out for is to invest, I would say, generally most of the time. And then there's a lot of ways that we can then go from there in terms of how do we get into investments and so on. But if we start with the basics around, what is an ETF, and maybe do you put it side by side with other, investment structures, or compare it to stock picking as an example? Can you unpack that, Billy, before we get into more detail?
Yeah, well, I think most people understand the concept of buying shares in a company, right? Like you buy BHP shares, you're a small shareholder in BHP, the company, buy shares in Commonwealth Bank, etc. Um, Another way to invest, which is how most financial advisors would do it, is through managed funds. And that just means you buy some units in this managed fund, your money is pooled together with all the other investors, and then there is a manager, hence managed fund. There's a manager who's investing that money, that pool of money for everyone, right? They're usually buying and selling shares with it. An ETF is I use the word modern, probably been around 25 years now, but a more modern version of a managed fund. And it's very similar in that it is a basket of shares that's managed. There's a couple of key differences. One is that you can trade the ETFs on the share market the same way you would a listed stock, as opposed to a managed fund where you generally have to put in an application and buy units in the managed fund. Like, it's not traded like shares. You have to apply to invest in it. ETF, you can buy and sell like stocks. And the other key difference is most ETFs are like an index fund. So as opposed to having a team of research analysts who's deciding what stocks to invest in, an ETF is usually tracking an index, i.e. it's just automatically buying, for example, the 200 biggest companies on the Australian share market. So it's automated, it's very low fee, and it just tracks a share market index.
And I think it's what
missed anything there.
and I think it's what really most people that don't have much experience investing should look at. Like, when I get asked the question around how do I it happens all the time at the school presentations I do for Beyond School, and I always get some sort of a question around what should I be investing in, and what's your best stock tip? Like, who hasn't ever heard that question 1,000 times? And I always respond and say back, look, get an understanding of what ETFs are, index funds are, and that's probably where you should consider starting, because you don't have to think a great deal about it, rather than doing what everyone else normally does to start. And I was no different, and I've spoken about it a lot on the podcast, where you just always start by stock picking, and I was no different. My first year I got lucky with buying A2 Milk. I bought early on a gold specky, a little gold company that I think the ticker code on it was MOY, and I think it's delisted now. So thank God I got out of this thing. But I got in, and it was like 18 cents. I rode it all the way up, and then it come crashing down on me, and I was negative, I think, like 80%. And then I was like, all right, what am I doing here? And so I just held on to it, and luckily it got back up to my price I bought in at, and then I sold, took my money, and then it crashed back down to zero. That was pure fluke. So there was no skill in that involved at all.
So also very poor advice. If your stock drops 80%, waiting for it to get back to
Oh yeah,
usually doesn't work. Like it would have been a bit of luck there.
I forgot to add, I was actually concreting at that time, so I wasn't a financial advisor. So that was me every day, like on my lunch breaks, I'd be like on my phone in the truck, and I'd be trying to figure out what stocks I'm buying next. So yeah, don't do what I did back in the day. But yeah, starting out with ETFs and index funds is a really good way of doing it, because you can diversify really easily. So rather than trying to buy a handful of shares or stocks, buying 5 or 10, you just put your money in maybe one ETF, and then you own 200 or 300 different companies just like that. So that's really the big key risk when you're investing into companies, is if that company goes busts or blows up in some way, shape or form, you lose your money. You don't get your money back. Whereas if you're in an ETF or an index fund that owns 200 or 300 companies, or a managed fund for that matter, if one company goes bust in that, providing it's maybe not the biggest one of the index, like say the CBA or a big miner, that's a different scenario. But if one company goes under, like, you're probably not going to really notice it, and it's just going to be replaced by another company that comes into the index or into the ETF anyway. So I think it's a really great way for people to start investing. And even then, when you start to get more experience, like if we talk a bit about, Billy, how we invest our clients' money, like we don't stop using ETFs or managed funds or those index funds and go back to stock picking just because we've got more experience. We still have those as a part of the overall portfolio. But I guess there's always that argument between active and index, and then which is the better and which do you do? Do you want to talk a little bit about that and your thoughts, and then how do we approach it?
Yeah, and this is the other thing probably that many people may not know is there's hundreds, thousands of ETFs now, thousands, right? So it's not like, oh, I'll just buy an ETF, I'm done. Or which ETF? How much? Are you going to buy more than one ETF? Which index? There's loads of different indexes.
Yeah.
So it's easy enough to buy one ETF, but that's generally, long term, that's not going to give you the best outcome, just picking one ETF and putting all your money into it. So your question, index versus active. So the vast majority of ETFs are what we would call index funds. They're tracking an index, and there's lots of different indexes to track. An active fund means there is some sort of research or analysis within that fund where they're picking stocks, right? They're deciding which companies are we going to invest in. Active funds, in my opinion, definitely have their place when you're investing. And what's a good example? If you look at the Aussie share market, it generally doesn't pay to be stock picking when you're playing around in the biggest companies on the market, like the big four banks, the big mining companies, the supermarkets. You're generally better off just buying the index fund rather than trying to figure out, is Westpac going to outperform ANZ? Yeah. So index funds are awesome for that. But if you're looking at the smaller companies listed on the Australian share market, it is much easier to apply stock picking in that part of the market, because there are a lot of unprofitable, dying businesses down in the depths of the Aussie share market. And so if you use an active managed fund, that manager should quite easily be able to screen out a lot of those companies that you just do not want to be investing in.
Mm. And that talks to a bit of like what we're doing at Link, of course, is we don't do really one or the other. We do both.
Yes.
In terms of with our investment committee having, a big proportion of the portfolio still does have index, that passive element to it. So there's really no tracking error to what it's going to do. Like if we've got an Australian index or ETF in there, it's just basically going to return in line with the ASX 200 or the ASX 300. Same for the international market, same for, property or infrastructure, whatever it may be. But we generally are holding 30, 40, sometimes maybe 50% exposure into some of those active funds, of which we can play around with from time to time in the aims of, getting some actual outperformance. But that's, of course, the hardest part of it is not all funds. It's not a guarantee if you go into an actively managed fund that fund's going to actually outperform the market. In a lot of cases, they may actually underperform. And that's, of course, the risk, because you're sort of getting into a bit of stock picking at that point in time. You're not doing it yourself. You're putting that trust in another fund manager or an expert team to be able to do that for you, but not all of them actually do outperform over the longer term, and hence why you do need to be quite careful around that. And I think we've seen, Billy, in the last couple of years, just by what's been going on, like where index funds have just done quite well, and it's been a tough market for some of the active fund managers, as opposed to other times where it might play to be a bit more active. Would you say?
Yeah, yeah, there's an interesting trend that's really accelerated over the last few years where there's a handful of gigantic companies listed on the share market, and buying those giant companies has been the best strategy by far. This is mainly in the US. What's it called? The Magnificent Seven. Google, Amazon, Apple, Facebook, Nvidia. If you just bought the US share index fund, you're basically buying those big companies. And over the last few years, that's been hard to beat because those huge companies, their share prices have just gone absolutely ballistic.
Yeah.
So now they're sort of like, a lot of investors have a short memory. So now they're going, right, that's all you need to do. Just buy the S&P 500 index fund. You don't need to do anything else.
Yeah.
It's like, well, that will work until it doesn't. Like all these things go in cycles, right? So at some point, that strategy will stop working. And that's where it will really pay to have active funds, small companies funds, infrastructure funds, other assets in your portfolio.
Yeah, wasn't there a piece or some research put out? I remember it was a few years ago. Was it Mike Burry or Mike Berry? The guy that the Big Short.
Short. Yeah.
Yeah, didn't he have some things out around ETFs being a bubble? Was that him that had some research around it? I may be thinking of someone else. I remember it was a few years ago. I thought it might have been him though, that was coming out swinging at ETFs. I could be wrong. We need to dig that up. But yeah, if he was saying it, it's it doesn't. You never know how it's going to play out. But he got the GFC right in terms of his call there. But yeah, we'll have to dig that one up and see for next time if that was in fact him. So I remember seeing something about it before. But if we talk a little bit about the other element of it as well, is the fees, because when you're actually buying stocks directly itself, you don't pay a fee in that company. Like when you invest in the company, you're not paying a management fee because there's no one's managing your money, so to speak. But you generally, when you're buying stocks or shares, you're going to pay some sort of a brokerage generally on the platform. So it might be a percentage, or it might be a flat dollar, $10 per trade, or there's a ton of different platforms out there that do it. But then when we look at the ETFs and managed funds and index funds, because your money is being managed, the manager does charge you a fee every year to basically manage your money for as long as you've got it in there. But then there's this thought of tracking error, whereas if you're investing in the ASX 200 or ASX 300, you should always expect to get the return of the ASX 200 or ASX 300. But because the fund manager is also charging their fee as well, that actually erodes on your return, and therefore you're never actually going to get the true return of the share market because there is a little fee. And then I was just having a look before, Billy, like if you look at the Australian stock market, looking at the ASX 200 and 300 there's only like there's a handful of main ETF providers out there. I think it's the A200, which is the cheapest on the market for the
one.
Yeah, for the ASX. I think it's the ASX 200, that one. And of course it is. And that's charging, I think, 0.04. So it's a pretty marginal fee. It's not much, but you're not going to get a true return to the index because they are charging you 0.04. But that is like nearly charging you nothing at that point in time. I think you've got to be a lot more careful when you start going into some other funds, of which can be charging you higher fees of 1 or 2% and above. I think that's where you've got to be a little bit more careful, because that 1 or 2% can actually have a material impact on your performance over the longer term. But other than the main fee that the fund manager would be charging, of course, there's transaction fees that exist on ETFs and managed funds. Do you want to touch on that?
Yeah, I mean the transaction fee is simple. Cases tend to be pretty low because you're pulling your money together with a huge amount of other investors. So they've got what's it called, like economies of scale, like very, very low compared to if you're trading yourself, your own stocks, and you'll pay your brokerage. Once you're in these funds, the transaction costs do tend to be low. There can be a factor of like tax, like because your money's pooled with everyone else, and they're constantly transacting within that fund. So there can be like capital gains tax can be a bit of an issue there. But generally speaking, if you're with a major provider, like a well-known ETF provider, and you're buying one of their products that's just tracking a broad index, like the Australian share market or the US share market, then costs and taxes generally aren't a big issue with ETFs. It's only if you're going for those more niche strategies. Like one of the ones that comes to mind, that the cybersecurity ETF.
Yeah.
Yeah, some of those like really niche strategies have just had wild swings in performance. That's where you probably got more of an issue with potential like tax and transaction costs and stuff.
Yeah, and I think we were talking, was it the other week? We were talking about the defense ETFs, and I think I was reading something last night on the plane home around a few of those have had like 50-60% returns over the last 12 months, and there's all this so much more spending that's going to be put into that place. Very interesting. And another thing I actually wanted to mention is when you talk about investing in ETFs and managed funds and indexes, it's worthy of noting you can do this in your own investment accounts or on your super fund, depending upon the platform that you're actually on. And this is where it's worthy of talking about the differences between like a wrap platform or a retail platform, which is what a lot of advisors may be recommending, versus say an industry fund platform or what's called a master trust. Because a lot of the main industry funds around, they have very limited investment menus and generally don't have an ETF suite or an index suite for you to always invest in. Some of them are better than others in the industry fund space. But whereas if you're on a wrap platform or a retail platform, like some of the ones that we use for our clients, like you can virtually invest in what you want at that point in time. It's a very broad investment menu. And the reason why I had that thought, Billy, is when you were talking about the taxes and things that can sometimes happen within these ETFs and managed funds that you can't control. The same thing actually occurs in your super fund when you are in a master trust product like an industry fund, because all of your money is actually pooled together and you don't see it, but there are taxes and everything it's transacting all of the time. You don't see it. It's actually factored into the unit price of your investments through your super fund. Whereas if you're on a wrap or a retail platform, like you in your super fund, you actually own the underlying investments yourself, and you can see how much shares you might have in some Vanguard ETFs or whatever it may be, iShares, but you actually own them yourself directly, and then you can always pinpoint the tax on any investment if you were to sell down or transfer out or whatever it may be. Whereas in an industry fund, you can't actually see that stuff. So this is the transparency is maybe another podcast topic we can talk about there at some point in time around transparency on some of the industry funds. But what if we move on to Billy, how do you avoid owning the same stuff twice across different ETFs? I think we sort of spoke a little bit about this earlier around, you wouldn't go out and just buy two ASX 300 index or ETF funds. Like there is no benefit in doing that whatsoever. But do you ever see clients, because I see clients sometimes mix and match their portfolios before I've even met them, and I see some interesting setups. Do you ever see that happening, and what would you say how to avoid it?
Yeah, that happens a lot. And I think it's because when you're DIYing investing, it's very hard to resist getting caught up in like the latest trend or the latest product and then so you end up like you keep adding more ETFs to your portfolio. And then we've seen it all the time. A client comes along, they've got 10 ETFs. Yeah. And you're like, 3 of those are hold almost the exact same investments under the hood. Like there's all this overlap, especially around like tech and AI and so on. You can buy all these niche ETFs that are pointing on one particular component. And then when you end up collecting all these different assets, we'll look at it and say, okay, there's 12 ETFs here. 4 of them are almost the same, just with different names. So it just comes down to having a clear investment strategy, not chopping and changing too much, and also just knowing what's in that ETF. And you can find out by going to the provider's website. Like it'll show you geographic exposure, i.e. how much is US listed versus European or Australian. Sector exposure, how much is in IT versus healthcare. And then there'll usually be top 10 holdings. That's what I always look at. It's the 10 biggest stocks that's in that ETF. So yeah, if you're going to go and add an ETF to your portfolio, maybe just make sure it's not, too similar to what you've already got in there.
Yeah, I totally agree, Billy, and I see it so often. And if I talk about some specific examples there, like if you start, everyone knows Vanguard, like one of the most popular fund managers around, commonly we'll see clients have some Vanguard in there or something alike to that. But if I've seen recently using, say, like the Vanguard High Growth ETF or index fund as an example, and then if you look into what that's actually investing in, it's investing in all of these underlying Vanguard funds. And I was just having it up now. The Vanguard High Growth Index Fund holds 31% exposure to, actually more, sorry, about 35% exposure to the Vanguard Australian Share Index an ETF, basically the managed fund and the ETF within the Vanguard High Growth portfolio. So if you own the Vanguard High Growth portfolio and then you start picking the Vanguard Australian Share Index as another fund in itself, you're just going to be doubling up on a lot of your exposure. And yeah, the point that you were just also saying there as well, Billy, like if, again, let's use the Vanguard High Growth portfolio as an example. That's got the Vanguard International Share Index in there. And then if you look into what that's then going to be holding, it's it's overweight US. So if you look at the Vanguard International Share Index, it's about 75% exposed to the US share market. So you talk about a Mag 7 before, that's basically what you're owning. But then I would commonly see clients might have a portfolio, but then they own the S&P 500 index as well. And then they're just doubling up on top of each other in all of these different ways that they would not have any idea about. Now, mind you, wouldn't have been a bad idea in the last couple of years, because like US stocks being those big caps, or the large caps have just been smashing it. But doesn't mean that that's always going to play out into the future. But that's another point I will also mention, that I was working with a client recently around the Vanguard High Growth Index Fund, and it's, mind you, if you were never going to like touch anything and never wanted to look at your portfolio, like it's actually not a bad option to consider. However, like when we give advice to our clients, like we're generally building some form of a tailored portfolio to them. And so I was showing this client, hey, look, you could keep using your Vanguard High Growth, or we use a portfolio that I'm recommending here that actually still had a lot of Vanguard funds, but it was way more tailored, and also threw in a couple of other options outside that, some geared funds to use if there's a bit of market distortion from time to time. The reason why I was showing it, I was looking at the performance over a 10-year period of time. It was 1 or 2% difference than using the off-the-shelf sort of Vanguard High Growth fund. So when you really dig down into it, there actually is a lot to consider if you want to get right down into the weeds, and wouldn't suggest anyone does that themselves, because it is pretty complex. Even some of the things that we're just talking about now may not actually make sense to everyone that is listening, but that's where you might want to consider, depending on the money that you're going to invest. That's maybe where you start considering, do you need a financial advisor who can actually help you make some decisions around the flows of your money, so you don't get out there and make some of those common mistakes. Is there any other common mistakes you can think of, Billy, that come to mind there? Or
Yeah, it's just very common to see people go, yeah, right, I'll buy some ETFs, and then do some research, pick some ETFs, put some money in, and then a year later they're like lost interest.
yeah,
And so like ETF selection is only one thing with building wealth. Like getting money in there is a key thing. So many people will put $5,000 in some ETFs and then just leave it there. 2 years later, it's worth 6,500. They would have been better off focusing on how to get money into the portfolio. And it's only once you've got that figured out, like your cash flow structure and your investment plan, how much you're going to invest, that's when like the actual fund selection becomes a bit more important.
yeah.
So sometimes it's sort of doing it the wrong way around.
Couldn't agree more, Billy. Couldn't agree more. And if we talk a bit about rebalancing, because that's obviously an interesting one that people probably wouldn't really know before. Like I don't hear the everyday investor kind of just talking about rebalancing of their portfolio unless they kind of really know what they're doing. Do you want to touch a bit on like rebalancing? Why do we do it? How do we do it? How that works?
Yeah. So if you're investing with like ETFs and managed funds, as opposed to say picking individual stocks, you've already got a huge amount of diversification, right? Like let's say I have a portfolio and it's 8 different ETFs. You've probably got thousands of businesses that you're investing in. So you don't need to do a huge amount of chopping and changing, because you're already spread across sectors and different countries and different types of businesses. What you do need to do, however, is just review that mix periodically. And it could be as infrequently as, once a year. But you do just want to look at, okay, which ETFs do I have? What percentage do I have allocated to each one? Is this still the best way to be investing? Has something changed in markets? The other thing is the portfolio gets out of whack because like one investment might perform really well that year and another one might perform poorly. So instead of having 20% in that ETF, it's now down to 15. So the key thing is you just want to review it at least once a year and just make sure it's in line with your well-rounded, diversified portfolio.
Yeah, I agree. And like you mentioned, that overexposure can happen quite often with funds that just perform really well, and then you might want to sort of pull back and take a bit of money off the table. And yeah, generally, if we talk about like clients that we're working with, the platform, we normally set the parameters so it can auto rebalance, and we can set it so it happens on a certain time of the year, quarterly, half yearly, yearly, whatever it may be, or you just kind of over time the portfolio would slowly get out of whack, I suppose, if you don't have those parameters in place. But yeah, typically that's obviously the basics of what we're going to be doing ultimately with our clients.
So Josh, I just thought also like the other thing there is if you buy all these investments and then lose interest, that can be a risk, because if you pick something that's like really like a niche or specific thing, like one example that comes to mind is if you bought like a gold miners ETF. Like gold can perform amazingly well, like it is now, for a period of time, and then it could go nowhere for 10 years.
Yep.
So you do not want to leave that investment to stagnate like without looking at it. Same as cybersecurity and things like that. Like they can really go through cycles. So that's really key with reviewing your portfolio.
And yeah, some of them you actually do need to sort of trade in a way, and I don't do that much. I don't do it often anymore, but every now and then I do it. And the last one I went in on was a highly leveraged NASDAQ fund, and it was really leveraged. But fortunately got in at a good time, and it doubled really quickly. And then I got out because it had already come back down. Now it's gone back up. But there are some funds that you do need to be a bit more proactively looking at and conscious of, because for those exact reasons. And I think talking about the rebalancing aspect as well, that can be done on like an individual fund level, or you could also look at it from an asset class level, or we call it like the SAA, strategic asset allocation, where you will look at how much Australian shares you've got, international shares, infrastructure, property, cash, bonds, whatever it may be. And sometimes that is maybe where you might do some reallocation, not just looking at the fund level, but also looking at your overall allocation, because we might take a view that Australia is looking really attractive for some reason, or large caps is not so attractive in Australia. We want to push more into the small to medium cap, but that is getting a bit more into more portfolio construction, which is not what the average everyday person is of course going to be doing. But other than that, Billy, I think we've cut off most of it. Is there any other thoughts or closing remarks in your mind around ETFs, the whole investment piece that we haven't covered off?
No, I think the main thing, really the main thing is like, if you lose interest, then you shouldn't be investing. Like either you should get advice or you should go back to cash. Like we've seen so often people buy investments and then they come to us and like, when's the last time you actually looked at this? They're like, oh, I don't know, 8 years ago. And it's like, oh, if you want to do it, it pays to be consistent. Yeah, consistently overseeing that, I think.
I like that. I haven't heard that one before, Billy. Get advice or go to cash.
As I was saying it, I thought maybe that's a bit too aggressive, but
no,
it's just about having a plan and sticking to the plan, right? That's all it is. Yeah.
We get what you meant. All good. Billy, do you have any exciting plans for the weekend, or are you just still moving into the house?
Just moving into the house, mate. I don't know. We've got a pub 300 meters away, which I haven't had that sort of experience in a long time, so I might have to pop down there for a
bit of damage. No, nice. No, it's good, Billy. I've got nothing major on my side of things. We'll just do a bit with the family and some things around the house, and then roaring to get back into the office on Monday after a week away. Roaring to get back in, mate. I'll be firing at all cylinders. But we'll wrap up and close out today. So of course, ETFs can do the heavy lifting if you set them up with intent. Build a clear core, add any satellites carefully, and let them do their job over time. And if this gave you a roadmap, hit follow, leave a quick review, and until next time, we'll see you on the Winners Playbook. Thanks, Billy.
Thanks, Josh.
Disclaimer. The information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you wish to book in a free 15-minute call to discuss your personal situation.